Dream of growing your trading account while you sleep, or trading millions without risking your own money? It sounds like the perfect setup. For intermediate Forex traders, two paths are heavily marketed to achieve this exact leverage: copy trading and proprietary trading firms. Both options promise a shortcut to larger capital and bigger returns, but under the surface, they operate on entirely different mechanics that demand serious specialized work. The slick marketing campaigns want you to believe these are effortless, set-it-and-forget-it income streams. Neither path is truly passive. Success in either requires reallocating your energy into a highly specific set of new skills. Selecting a model depends on how your current trading skills, available capital, and risk tolerance align with these two distinct types of work. Choosing the model that conflicts with your actual strengths introduces structural risks that can be more difficult to manage than traditional trading. To consistently scale your returns, you have to drop the passive income illusion. Treat the route you choose with the exact same rigor as a strict corporate job. Copy trading reduces your screen time by automatically mirroring the daily market analysis of a signal provider. This chart maps the relationship between control and responsibility. Success in copy trading requires the mindset of a fund manager, where the primary work is continuous auditing of signal providers, rather than executing individual trades. The major risk you take on is delegating your money to a trader using reckless methods, like a martingale strategy, where they double down on losing bets to force a win. This graph illustrates the trap. A high-risk strategy produces a perfectly smooth upward equity curve for months. Then one normal market shift occurs, and the entire account is wiped out overnight. You survive this by enforcing your own risk parameters. Good platforms allow you to cap your maximum stop loss across your entire portfolio, or force the system to only copy a fraction of the provider's lot size. Since traders eventually lose their edge, protecting your capital requires you to actively rotate your funds from failing providers and allocate them to better performers. Then there is the cost. Providers don't work for free. You will typically pay a performance fee, a direct percentage cut of any gross profit they generate for you. If your provider has a great month and makes you $500, a standard 30% performance fee eats $150 of that immediately. Your actual yield shrinks fast. Copy trading removes the stress of executing trades yourself, but it replaces it with the heavy burden of managing risk and managing people. Proprietary trading firms offer a different approach. Here, you get access to massive blocks of institutional capital, meaning you don't have to risk your personal savings. To get that funding, you first have to buy your way into an evaluation. You pay a non-refundable challenge fee to prove your trading skills. Bringing back our quadrant chart, look at where prop firms sit. You retain direct control over every trade, but your performance responsibility hits the absolute maximum. Challenges are built to filter out reckless behavior. They enforce rigid overall and daily drawdown limits, often capping your maximum loss at 5% in a single day. Trading other people's money under these strict conditions generates intense psychological pressure. One emotional mistake or one attempt at revenge trading means instant failure and the loss of your challenge fee. Do not attempt a challenge unless you already possess a heavily back-tested, flawless trading strategy. The reward for surviving this gauntlet is significant. Once funded, you split the profits with the firm, frequently keeping 80 to 90% of the returns for yourself. Because your margins for error are so thin in a simulated environment, your broker's technical conditions, like execution speed and tight spreads, dictate whether you pass or fail. Prop firms test your execution under fire. They demand robotic discipline in exchange for the capital you need to scale. The choice between these two boils down to leverage. Copy trading scales your capital using someone else's skills. Prop firms scale your skills using someone else's capital. This decision tree will clarify your path. First, what is your primary bottleneck? If you lack the hours to watch charts or the emotional control for daily setups, move down the left path. Next question, are you willing to rigorously audit managers? If you won't do due diligence, avoid both paths. But if you're ready to be an active risk manager, your verdict is copy trading. Back to the top. If you have time and a proven edge but lack capital, move right. Secondary test. Do you have ironclad emotional control to survive strict drawdown limits without revenge trading? If you can operate like a machine and need capital leverage, your verdict is prop firms. Neither option forgives laziness, but aligning your choice with your natural bottleneck guarantees a higher probability of success. Identifying your path is only the first step. Executing it on a platform that actually supports your chosen model is the second. If you took the portfolio manager route, you require a platform that allows granular, manual overrides of copied lot sizes and stop losses. FXNX's NX copy ecosystem is engineered exactly for this, giving the investor that specific layer of risk management control over their signal providers. If you chose the prop firm challenge, your requirements shift. You cannot afford a single pip of slippage ruining a strict drawdown limit. Passing those evaluations requires ultra-fast execution and zero pip spreads, like those found on the NX1 account. Abandon the fantasy of effortless money. Confidently choose your specific brand of hard work and leverage the right technology to scale it.